Hey everyone, can we start getting back to our seats? So, because I will be probably talking more than I should, so we should probably start soon. So, can everyone hear me okay in the back with this volume? Yeah? Okay. So, my name is Alessandra. Despite having a very Italian-sounding name, I should fully disclose that I'm Brazilian because apparently some people thought I was Italian, which happens often. But I'm Brazilian. I know we have at least 2 Brazilians as well in the EPOG cohort. I think there's a long tradition. 3, 5, 6? I thought I thought our year we were 6. We were a lot. Things never change. Since Davide already disclosed that we're dinosaurs, I'm also a dinosaur. I was also from his cohort from the early years of EPOG. And today I'll be talking a bit about the work I did while I was working at the OECD. So the presentation is going to be about investment tax incentives. I thought before I start, I can, without having the intention of running you guys through my CV, just explain a bit about my background and what I've been doing since actually the 10 years since I left EPOG. As I mentioned, I'm Brazilian. I did my bachelor's and my master at Unicamp. I don't know if there's Brazilians from Unicamp. I see smiling faces. That's good. And then I did EPOG, and after that, I actually joined the UN. I worked for the United Nations Industrial Development Organization. That's based in Vienna for a few years before joining the OECD. Initially, my focus was actually industrial policy. So I worked on FDI, which is an industrial policy more from Latin American perspective. And then while at the OECD, I started working more on investment tax incentives. And so before at the UN, I worked again, it was research, applied research. So like Davide, my work is as a practitioner, we call it, as someone who works in international organizations, very much from an applied point of view. You'll see that there's some intersections with research because my area is applied research and policy, but you'll see there's a very different take and a very different perspective on all of these topics that I'm going to be discussing today. So what I was planning on doing today is presenting this paper, which I authored with my 2 colleagues in 2022. It has a very heavy-sounding title, Assessing Tax Relief from Targeted Investment Tax Incentive Through Corporate Effective Tax Rates, Methodology, Initial Findings for 7 Sub-Saharan African Countries, which is a mouthful. But before I go into this paper, I thought it would be interesting to actually contextualize this work sort of within the agenda of the OECD, how it came about, because I think it's not your typical OECD publication, your typical publication you would expect coming out of the OECD, because it's focused on a very, let's say, developing country point of view, which is investment tax incentives, and it's also looking at sub-Saharan Africa, which is also not that common. I mean, there is a lot of work on non-OECD member countries. That's mostly through the Development Center at the OECD. That's actually focused on this, but that's not the part of the house that I worked. But before that, and then I'll talk a little bit, of course, about the paper itself, the results, and some current topics related to this tax incentives. So first, a quick introduction. I think it's always worth just making sure we're all on the same page in terms of what I mean when I talk about tax incentives. This is just a definition. I think this is the one I use in the paper. So tax incentives, or tax expenditures, they're sometimes called, are preferential tax treatment relative to a benchmark tax system, so the standard tax system of a country. And they're essentially designed to encourage a specific economic activities, investments, or behavior. So that's why they're targeted, as I mentioned in the title of the paper. So it's important because benchmark tax systems or standard tax systems, as we know, are very different depending on the country, right? So this is just this is just a chart, and what we have here is essentially the corporate income tax rates, the standard or statutory rates for different countries, for I don't know how many countries at this point that they have from this database. And you can see that they go all the way from 0 up to 36%. And essentially, if we have just a few countries, I just picked out a few to take a look. If we have Ireland providing a corporate income tax rate of 13%, that is not a tax incentive. That's just their standard treatment. That's just their system. So if we want to say that Ireland or the Bermudas that has a 0% CIT rate, this itself is not an incentive. So we're going to be talking about incentives are deviations or incentives or tax provisions that allow you, a company, for example, to deviate lower than this benchmark. And I think another topic which is just quickly worth mentioning is why are we talking about tax incentives in the first place, right? Why are we talking about incentives in general? It's one specific instrument out of like a multitude of instruments that you have, one type of incentive. And so why are we not talking about, if we talk about grants or, subsidized loans, these are other types of incentives. And this is just from another OECD report, but there is, let's say, apparent incentive, or they call it the popularity of tax incentives. It might be linked because they're apparently easier to administer in the sense that it's legislation that's passed. It goes through a system that already exists, right? Through tax legislation, through your tax return. So it might be easier to administer. It's easier to operate than setting up a grant system or things like that. And there's also something that's very crucial, especially for developing countries, is that there's no upfront cost because they're foregone tax revenues. Instead of having to put money for incentive, you actually just don't collect the money that you would. So for cash-constrained governments or governments with little tax revenue, that's actually an incentive or like a reason why to use them. And at the same time, there's this idea that tax incentives are more, I would say, more non-discretionary. And that means that essentially you're not picking the firms that would benefit for support on a case-by-case basis. So essentially, you would have a provision, so like an article in the law that specifies exactly who gets a benefit, and that is more transparent. So the who is benefiting versus who is not benefiting is clearer to everyone, and there's less discretion and potentially less room for corruption and picking the winners, let's call it. So when we talk, we know a little bit of what is tax incentives, what's not. When we talk about tax incentives in general, there's different perspectives, or you can divide the topic into, let's say, different fields. We're going to be focusing on this first one, which are tax incentives for investment. This is more of a discussion related to incentives to investment itself, but very much linked to the discussion of FDI, attracting FDI, special economic zones, also using incentives for regional development, as they are used, for example, in Brazil as well as Argentina, to basically attract investment to poor regions and within a country, for example. And this is primarily a discussion of business taxes because it's private investment, it's for businesses. This is a bit different from the discussion for tax incentives for innovation. And those are incentives much more targeted with the objective of getting companies to spend on innovation. So there are tax breaks for companies as long as they spend money on innovation. They hire scientists, they register patents, things like that. This is also very similar in business taxes. And these two are quite closely related, but this tends to be more of a developing country issue, and this is the developed country issue, because this is where the innovations are probably going to occur. This is closer to the innovation frontier, and there are different issues related to these topics. We're going to focus on this one. But just to quickly mention is that tax incentives is also a discussion of using tax incentives a bit for equity, I called it. But it's related to then, how can you use incentives to redistribute income? If we're thinking of personal income taxes, but you can also discuss how can you reduce the tax burden for small companies, so there's a more even playing field between large companies and small companies. You can also think of, cost of living support, and this covers a lot of different types of taxes. We're not going to go into that. And then I just wanted to add, there's also the discussion of tax incentives for green transition. And there, again, it's a mix of, having targeted innovation for green transition, or maybe, it's like about changing consumption patterns and how you can do that through the tax system. Again, unfortunately, we're not going to go into these two. We're going to be focusing primarily on this first one. And I think just, again, talking about this first one, tax incentives for investment, as I mentioned already, we're going to be focusing on business taxes and particularly corporate income tax. That's what we're going to be talking about most of the rest of the presentation. And why is CIT important? Essentially, because CIT revenue is actually a more important tax revenue source for developing countries than it is for high-income countries. This graph basically tells you with the different bars, you have different main types of revenue sources, so different taxes that bring in revenues for governments, and then it just shows you the average for the OECD, and then for regions, so this includes developing countries, this does not. And essentially, if you look at this orange bar, you can see that it's much higher. It's much lower for OECD countries relative to other regions. That's essentially because for OECD countries or high-income countries, personal income taxes and social security contributions, blue and green, actually represent a much higher share of tax resources than they do in other countries. So again, this is why developing countries are interested or concerned about this, of how do you continue getting resources from corporate tax. Now, before I go and start talking a little bit about the paper, I wanted to contextualize where this topic comes in at the OECD. So, as I mentioned, I worked there for several years, and I want to explain a bit how this fits into larger work or larger agenda of work that was happening at the organization at the time. So, as Davide also had a slide on governance, I'm happy I also have one, a very simple one, but I think it's also, it's important to understand or explain. I don't know if anyone is familiar with how the governance of the OECD. Don't worry, I won't ask you to explain if you do know, but basically, I thought it's worth actually explaining how work gets done or how an agenda gets set at the OECD. So basically, within the OECD, you have a council, which is kind of like a strategic oversight body. And in the council, you have each member country from the OECD actually has an ambassador to the OECD that is part of this council, as well as the Secretary General of the OECD Secretariat, which is the body that executes the work that is mandated by the council. And under the council, you have different committees. So these committees, similar to, again, within ESMA, there are also different committees. So these different committees are different bodies that conduct substantive work in different areas or different fields, different topics that the organization covers. And they work under this strategic oversight or the strategic guidance of the council, and then they bring that down a level and bring it into an actual agenda of work for each different areas. So I think committees themselves are over 50, but if you include working groups and expert groups which are under these committees, you end up having more than 300. It's quite a big organization. And just to give a few examples, we have, for example, the Investment Committee and the Committee of Fiscal Affairs, which are the two I'm going to be talking about today. But then you have other committees on many, many different topics that go from Committee on Fisheries, if I'm not mistaken, to a Committee on Industry, Innovation, Entrepreneurship, Regional Development, everything. And then you have people who work for the OECD. The OECD are called the Secretariat. And the Secretariat is divided into different directorates around different topics. And people from these different directorates answer or implement the work of these committees. That's enough. I won't talk more about governments. But that's important to understand because under these different committees, you have agendas that are being set. So talking a little bit about the investment committee, which is one that links or has work that was being conducted on investment tax incentives. So these committees, they're often associated to what are called OECD instruments. And instruments within are legal documents from the organization that set out basically standard rules, guidance for member states to follow. If they want to be members of the OECD, they need to adhere to these standards, essentially. Within the investment committee, which is talking about investment, as you might suspect, we have something that's called the Declaration on International Investment and Multinational Enterprises. And along that, you have OECD guidelines for multinational enterprises. This is basically a set of guidance or rules that are legally binding to an extent, this one, that tell you guidance for essentially how OECD countries should, in a sense, regulate or have their multinational enterprises operating. And along this, you have these OECD guidelines for multinational enterprises, which are voluntary guidelines for these MNEs and how they should conduct their business. This is something that it's a legal instrument that was introduced in '76, and it's led to a lot of work related to FDI within the OECD. So essentially what you had is these are more focused on OECD member states, and then you have a line of work that's related to if countries want to then attract investment from FDI from OECD countries, what are the sort of policies they should implement in terms of being attractive to those companies, those multinational companies. So for example, in 2003, you had this checklist for FDI incentive policies that came out, essentially giving good practice advice in terms of what policies you should implement. 2006, you had the policy framework for investment, which took a step further, started looking at other topics. Among them, tax incentives. So there's guidance for what does a good tax incentive look like, but more in terms of initially it meant just having everything being published. There's a focus on transparency. So it's about having incentives that are accessible, has information, so everyone is aware of the incentives being given. And over time, it became a bit more nuanced, let's say. And this declaration also became a bit more, or both the guidelines and the declaration were updated regularly to include a few more things. So trying to go briefly here, in 2011, for example, they included in these M&E guidelines human rights due diligence, so increasing sort of the responsibilities of multinational enterprises or guidance in a voluntary kind of way in terms of how multinationals should act. In 2015, you also had another of these PFIs, they're called Policy Frameworks for Investment. And then what you actually had during the past 10 years is sort of the shift towards what was called initially through the FDI Qualities Initiative, which was trying to link more FDI towards SDG associated, so sustainable development or sustainable investment. So there are different measures, and they started looking at the link and thinking as well how different incentives, including tax incentives, could actually support sustainable investment more. So this kind of explains why they would be interested in understanding investment tax incentives, and particularly how you can link it with sustainable investment. In another part of the OECD, you have the Committee on Fiscal Affairs. Committee of Fiscal Affairs, as you might suspect, talks about fiscal affairs. Particularly a part of it is about tax revenues and tax policy. And that's the part which this work comes in. Since the 2010s, you had different publications on tax expenditures in OECD countries, evaluations of the effectiveness of tax expenditures or tax incentives in Italy, for example. And from 2017, actually onwards, you have increasing work on R&D incentives within the OECD context. So you have these two papers, for example. At the same time, another part of work that was actually going on related to this committee was that in 2008, with the financial crisis, you actually had a lot more attention focused on corporate tax avoidance. Again, avoidance, not yeah, not evasion. But basically, what came across was in the years after the financial crisis, and as well with, a lot of money being distributed in the recovery of the financial crisis, and a bit more awareness of like how large multinationals were operating, is that there was a lot of aggressive tax planning from a lot of these companies. So essentially in 2012, there were a lot of committee hearings, both in the UK, US, different countries in Europe, around how little tax large multinationals were paying, actually, if you took a look at their specific numbers. And at the same time, you actually were coming from a trend of statutory CIT rates declining. So this again is just the statutory average, statutory CIT rate for different regions. And you can see, not so clearly in this dimension, I guess, but at least from here until 2010, a quite sharp decline, I would say, since this is the average. You can look at the OECD, particularly in the OECD, where you drop from the average CIT rate from around 32 to, well, 25% by 2015. So it's two issues of declining rates, so changing base, as well as different loopholes that result in countries paying less. And in parallel to that, you have what is called, often called the race to the bottom, which is a dynamic more, well, international, but also more discussed in the context of developing countries, which is basically developing countries competing to attract FDI, and through that competition, essentially racing to the bottom and offering more and more generous tax incentives or special tax regimes, and resulting in companies that were actually also paying very little tax in developing countries. So it's not only a developed, but it's a developed and a developing country issue. So what happened was, in this aftermath around 2012, you had a growing interest from the G20 in actually doing work on this and exploring this and dealing with this issue. So by 2012, you had the G20 mandated the OECD to do work on base erosion and profit shifting, essentially. And this actually led to an action plan of how they were going to do this by the following year. And this is just an overview of the different buckets or different areas of work that they came up with in this action plan. So I won't go through all of them, and a lot of them were actually much more focused on regulation. So let's say they were much more lawyer-driven. It's about changing legislation, not so much from an economic impact point of view, I would say. This one was one that was there was a lot of work done here, and I'll talk about this a little bit later. So there are tax challenges arising from the process of digitalization or digital services, for example. There's additional data being collected through country-by-country reporting, which is essentially companies collecting data on how their own multinationals are operating around the world. So there's a lot of effort around collecting data. There's also work being done on harmful tax practices to try to exactly reform these more harmful regimes. And all of this eventually by 2016 led to the launch of the OECD G20 inclusive framework on BEPS. So this inclusive framework, essentially what it did was it brought into the OECD, or at the OECD, which was the body that was implementing this work, a larger group of countries, both OECD and non-OECD countries, cooperating in the context with the mandate of the G20 to deal with this issue of BEPS. So that's what is called the inclusive framework, and you'll see in a bit. But essentially by 2019, they had come up with this two-pillar solution proposal. And they had, within this proposal, they did what was called the first economic impact assessment, and I'll show you what that was in a bit. So this two-pillar solution, which I don't know if anyone is familiar with that. Maybe a bit. Perfect. So essentially two pillars. We're only going to be talking about this one, but I think it's worth mentioning both. Pillar 1 was related to the reallocation of taxation rights. This is mostly related to digital businesses. So there's the real case of, for example, Indonesia, that has there are a lot of people in Indonesia who use Netflix, but Netflix is not based in Indonesia, it does not operate in Indonesia, it operates somewhere else, but it's a digital service, so therefore the company is based in the US, but still they're consumers in countries that are not then able to tax that service. I won't be talking about that, but we can talk about it a bit more. I'm not an expert during the Q&A. And then what we'll be talking a bit more about today is related to Pillar 2, the global minimum tax. Initially it was called the Global Anti-Base Erosion Rules, or GLOBE. And this is essentially the idea of setting a minimum effective tax rate for large multinationals with consolidated revenues above 750 million euros per year, so very large companies. And we can talk about that later, but essentially the idea is to set the floor to this race to the bottom and make sure that companies are paying at least a minimum. In this economic impact assessment that they did a bit after, they actually tried to model what would be the revenue gains from this implementing these tax. I won't go too much into this, but if we look at here at the panel 2, you can see essentially that they were expecting to increase revenues, tax revenues, for all income countries, high income, middle income, low income countries, and this is essentially shifting revenue that is not being taxed from basically tax havens, are called in this report, they refer to them as investment hubs, but shifting them into these other countries through what's called an interlocking mechanism, but we can discuss that later. Essentially, there was also a bit of criticism around that time, because it was a discussion of, first of all, why is this discussion happening at the OECD? As well as, do developing countries stand to gain or lose? You could see from the previous slide here that actually the gains expected for high-income countries are actually higher than for middle-income countries. So there was some discussion around the design, how this was designed. Some developing countries were worried. The African Union, or related to ATAF, African Tax Authority Forum. I'm not sure what but ATAF, essentially the African Coalition had a very big voice in these discussions, and they banded together and made a very strong front in terms of their views. But that eventually moved forward, and but essentially the main takeaway is that developing countries were concerned about this. So there was, for example, a roadmap for developing countries of how they would implement this, as well as a growing concern around tax incentives, because developing countries rely a lot on these tax incentives to attract FDI as one of the ways to differentiate themselves, let's say, from other countries and compete with developing countries through that angle, let's say. So this in 2022, there was a report on tax incentives and global minimum tax. So again, you see the link with tax incentives. The issue is that what do we really know about investment tax incentives use worldwide? It turns out that it's actually surprisingly little. We know a lot, but it's complicated, it's nuanced. And I mean, the first question we can ask ourselves is FDI actually sensitive to taxation, right? I think that's a very important initial question. And it's not a given, right? It's as with any complicated question, the answer is also complicated. So if you look at the literature, there's literature that says, yes, there is evidence. These papers actually focus more on the developed countries. You also have literature mainly from China that looked at the effects of special economic zones again, and see if they were helpful in actually helping create jobs, create growth, things like that. You have literature that says categorically no. This is often focused on studies that were developed in Africa, where there was a lot of tax holidays, for example, that didn't lead to any growth or any positive effects. And in my view, the answer is it's mixed, because there's a lot of non-tax factors, and it depends on the context. It's more complex. And another question is, it's one thing to say, is a tax incentive important or not? Does taxation matter? But then you can go a bit more a step further and say, like, but how you design it does it matter, right? How important is it? And the important thing is, when we talk about tax incentives, there's a lot of diversity in design. And you usually distinguish between income-based incentives and cost-based incentives. Essentially, income-based incentives apply on income or profits they're already acquired by a company. So you can think of a company that has a certain amount of profits that they generate. And then if you have a tax holiday, for example, they don't have to pay tax for 5 years or 10 years or something. The issue with those is essentially that the more profits you have, the larger a tax benefit you're actually receiving. On the other hand, you have what are called cost-based incentives, such as tax allowances and tax credits. This depends on how much you spend. So if you spend more, you get more of a tax break. So the idea is that this one is tied, the one in green, the cost-based ones are tied to expenditure. So you have to, you spend and you get a benefit. The other one is more, can benefits equally, or actually can benefit more companies that have higher profits than those that are actually struggling. And there's a lot of difference in design. I won't go into, we can discuss this if you guys want to during the discussion. But essentially the difference is that these tend to be, or are suspected to be more used in developing countries, and these are less used in developing countries because these are more, essentially more difficult to administer from a tax administration point of view. And that's the general, what we know. But when you go, sorry. So developing countries generally use, let's say, based on the general knowledge, that's what you generally expect. Developing countries use more of these in blue. Developed countries use more of the ones in green. But as you see, like, what is really this based on? It's how do you come to these conclusions? What is this? Essentially, what data is this based on, or this conclusion based on? And there's essentially two ways to go about it, of what do we actually know about these tax incentive use. There's two data sources, let's call it. You either have tax incentive inventories, and inventories are essentially a catalog of the incentives, details, the information registered on incentives designs. Targeting is who benefits from them. But there are no worldwide inventories. They're costly to collect. There's nothing really available. And essentially, often they're also not available at the country level. So a country will not have a catalog of its own incentives. This is particularly true of developing countries, or if they do, it's not publicly available. And on top of that, when you have tax incentives, it's generally not consolidated in legislation, which means there's not one law that has all the incentives. They're actually spread out, there are provisions spread out across multiple laws. So it can be, this is not always the case, but it means that it's difficult to understand. On the other side, you have, closely related to this, you have what are called tax expenditure reportings. This is something that started happening in the 1970s. And it's basically estimates of tax incentive costs. I won't go too much into detail, but I think it's just worth knowing. I'll show some data from that after. And now talking a little bit about the inventories themselves. You have, PwC, for example, has a global tax guides. These are global tax guides, but they're essentially reports that talk a little bit about incentives in different countries. You also have, for example, the OECD R&D incentives database, which is very detailed. But the issue is that it's focused on R&D incentives, so it doesn't give you a full picture. You have different research or databases that were built in the context of projects, such as this IGF one, which is about mining tax incentives, but it was not continued. It's a one-time thing. It's limited against scope. And then if we're looking for things which are a bit broader in scope and are, again, focused on CIT in developing countries, we basically have 2, 3 solutions or alternatives. One of them is the work that the World Bank was doing prior to 2019. And this is basically data that was collected in the context of different projects. But the data is not super detailed. It was not published. That's an issue. Then you have the OECD Investment Tax Incentives Database, which is work that I was helping develop at the OECD starting 2019 as well. And I'll show a few details from that. And you have the World Bank CIT Incentive Database. I think it's what the final name that it's actually called. And it's very similar to the work that we were doing, and we were in contact with them, but it's since been published in a few different reports. You can look at it if you're interested. The problem with both of these is, again, that the microdata that we collected in context of both these projects are not publicly available, but you do have some information. I can quickly go through what this database includes. And essentially, talking more about the OECD one, which is the one I'm familiar with, what we did was collect information on 3 different areas, let's say, to try to answer 3 different questions around tax incentives. So essentially, we collected information on design features. That means, how does the incentive reduce taxation? What instrument, what design, what channel? We'll go into a bit on this detail of that. We also collected information on eligibility conditions. So that means which investors and projects qualify to receive the tax incentive, who benefits from this, and information of how is the tax incentive governed. So what is the legal basis, how is it applied, different issues around that. And with a lot of work, eventually we arrived at this, what looks like a very simple figure, but it essentially tells you a bit more about tax incentive use in developing countries, which updated, let's say, data I think was the most up to date before this was 2016, I think. So this was an update to that. Work, basically updated work, the findings, let's say, that the World Bank had done almost 10 years previously. And essentially what this graph here shows is for 70 countries, which this is the 2025 update. So we had mapped incentives from 70 different developing countries. And then we basically look to see what share of countries among those 70s have different tax incentives, different instruments. So remember I talked about income-based, expenditure-based. We have income-based, expenditure-based, income-based, expenditure-based, sorry, income-based, cost-based, I mentioned. Income-based, cost-based. And this basically, in a nutshell, what this figure shows is that, yes, developing countries use tax exemptions a lot, more than they use reduced rates, which is another type of income-based incentive. But initially that suspicion that, actually developing countries don't use expenditure-based incentives is only partially correct, because it seems that there's actually a quite high share of countries, especially low-income countries, that had tax allowances. These are often linked to mining, so they're accelerated depreciations for mining expenditure or other industries related to basically mineral, it's usually mining or oil exploration. But with tax credits, it does seem indeed that actually at least upper middle income countries tend to use them more. We also collected information on essentially, again, who benefits or what are the conditions that you need to essentially benefit from one of these incentives. We looked at, what this graph here tells you from those 70 countries, what share had an incentive that required you to operate in a specific sector, achieve a specific outcome. We can discuss that in the discussion. Anyways, geographic region, investment size, different conditions. And what that allowed us by collecting information on these both dimensions is answer or look at pictures a bit more in detail in terms of tax incentive use. So for example, this picture here, what we have is basically the breakdown of the tax incentive instruments, but now only looking at incentives being used inside special economic zones. So if we zoom in on special economic zones and try to see what are the policies being used within the zones, what we see here is the blue, which is the policies used in zones, and the orange, which are policies used outside of zones in each country. And we see that exemptions seem to be used both inside and outside of zones. But if you look at the blue bar and the difference in heights of the blue bars, basically it tells you that special economic zones are essentially about tax exemptions. They're not really about other incentives. So if we want to talk about special economic zones, we should talk about tax incentives. Linking it back to that discussion that I mentioned about the investment committee and the FDI qualities, one other thing that we looked at was whether incentives were linked to sustainable development. And we can, again, I won't have time to talk about this, but essentially see how we made this link. But we looked to see if countries were using incentives that supported reducing environmental impacts, promoting exports, supporting employment and job creation, job quality. And then we looked to see what type of design they were using to try to target those, let's say, sustainable development achievements or areas. So this basically tells you, were they targeting sectors? Are they using design features such as qualifying income, qualifying expenditures to make this link back? We can discuss this more in detail after. I will skip this a little bit, but just to talk about a little bit about tax expenditure reporting. Essentially, as I mentioned, this is putting numbers or trying to estimate the cost of these policies. This is a report from the UK. And basically what you see is they estimate the cost in billion pounds of different incentives. Here it's broken down by type of tax. So income taxes here, you can see it's actually less than VAT and capital taxes, but it basically puts a number to how much the taxpayer is paying without directly paying. And I just wanted to make a link with this because this is a part of what is used to then arrive at figures, such as, for example, how much subsidies are being given to fossil fuel companies, for example. So you basically go through all of these inventories, all these tax expenditure reports, and you pick out the ones that are benefiting fossil fuel companies, and then you put that all together, and you arrive with a number of, for example, in 2022, 1.6 trillion, I think, 1.6 trillion dollars were given to to fossil fuel producers, coal, electricity, natural gas, and petroleum products worldwide. So just to make the link. And it also gives you, if you put it all together, it also gives you a nice figure, for example, telling you that 5% countries spend on average spend 5% of their GDP on tax breaks to companies annually. Let's skip this. But now going towards the paper that I'm actually supposed to be presenting, all of this has an issue because of comparability. So how do we bring that together? How do we compare countries? Because we talked about inventories, we talked about expenditures, but as we saw in the beginning, the problem is the benchmark tax rate or the benchmark tax system is very different from different countries. So how do you deal with the fact that in a country that has a 10% rate, there's no incentive, but a country that has a 20% rate, but then has a special economic zone that provides a 10% rate, that is an incentive. So that means that if we look at the tax expenditure reports, this is going to be estimated in the tax expenditure report, but this is not going to be in the tax expenditure report. How do we also deal with the fact that incentives are different? So if you have a country A that has, for example, a 25% CIT rate, and it has a special economic zone that has a 5-year tax holiday, how does this compare to a special economic zone that has a 10% reduced rate? Which one is more competitive? How do you know? And essentially what we see, again, going back to the OECD tax incentives database, is that just looking at tax holidays, if we look at how long these tax holidays last, we see kind of a peak around 5 years and 10 years, which means that most countries, I mean, it's more than 25% of countries actually had tax holidays that were the 5 or 10, but not 3, not 4, not 6. It's very concentrated. So what this actually tells us, in my view, is that there's a competition to provide incentives, not based on the actual benefit that they provide, but based on the headline incentive that they provide. So instead of saying, I have a lower tax rate, and therefore I can give you a 3-year tax holiday, because the other country is providing a 5-year tax holiday, I will also provide a 5-year tax holiday. So the baseline doesn't matter so much. What matters is the advertised incentive. So how do we deal with this? And the way to deal with this is looking at the effective tax rate rather than the incentive itself. So if we look, let's first understand what is an effective tax rate. There's 2 types. The easiest one to understand is actually a backward-looking effective tax rate. And essentially that is just how much, for a corporate income tax point of view, that's essentially how much corporate income tax was paid divided by the pre-tax profits. So it's simple. It's of your pre-tax profits, how much did you pay? The advantage is like to calculate it is actually based on real behaviors or past data, past financial data, past performance. The limitation is that you usually require tax return details to be able to calculate this, because this is often confidential data. So it's difficult to have enough information. So when you see studies around this, it's usually published by someone who, for example, works at the Ministry of Finance or has access for one reason or the other to this confidential data. The second option, which is the one we'll talk a little bit more in detail, are forward-looking effective tax rates. And the alternative is to take this concept or the idea of effective tax rates, but instead of looking at real data, is to model it. So essentially you model it and you take a modeled, standardized investment project across multiple countries, and you look at it through the economic lifetime of that project, and you take into account depreciation, you take into account incentives, for example, and you see what the effective tax rate would have been. The advantage is you don't have a lot of data requirement compared to the other one. The limitation is that it's a model and it's a simplified view of reality, right? So just to illustrate, again, effective tax rate calculation, how it actually happens. So if we think of a company that has a revenue of 130, for example, dollars, whatever, and we take a look at the operational expenditure that it has, for example, 30. We arrive at a net income after the deduction of these operational costs of 100. This is where you would start to enter, for example, the tax return filing, let's call it. So after you have your net revenue, you can deduct what are called standard depreciation clauses, provisions. So essentially it's because if you have a capital investment, you're allowed to deduct part of that cost over years. So if you buy a building, for example, that building has a lifetime of 30 years, so you deduct 1/30th of the cost over the lifetime. This essentially reduces your taxable income. This taxable income, then a tax rate applies. A tax rate of, like, in this case, 30% applies, so 30% of 80 is 24. You actually owe, at the end, 24. If you look, just in this case, you have a headline of 30% CIT rate, but just because of the effect of the standard depreciation in this case, you end up with an ATR of 24, which is this 24 divided by this 100. So, where does that leave us? How do we put forward-looking effective tax rates in this context? Essentially, what we're going to do is I'm going to focus only on one indicator. There's multiple indicators, but there's one indicator that's called effective average tax rate. And it's the idea of summarizing the effective taxation on a comparable but mutually exclusive project, but assuming that it's essentially, okay, the thing to take away is that it's a profitable project, and we're looking at it over its lifetime. So essentially it's average because it's like, let's call it investment project the last 10 years. And we look at how much tax was collected, would have been collected over that 10-year period, the income that was, the revenue that was generated from those 10-year periods, and we summarize that into a EATR indicator. Of course, in real life, it's not that simple, but with these forward-looking ones, that's how we calculate it, essentially. And this is, without going too much into the equations, this is essentially what this equation then represents. You can calculate it one way, but essentially the way I'm talking about it is, remember that backward-looking approach where you had the taxes, you essentially had the taxes due divided by the income, or in this case, the net present value of the pre-tax net income. But essentially, this means this is the income stream that the investment generates. These are the taxes paid. How do we calculate those taxes? In this context, what we're going to do is similar to that waterfall chart that I talked about earlier. We had, for example, we had that income. Here we have, it's the investor's revenue net of variable costs in period T, that 100 from that previous figure. Then you have, from that, we deducted the standard capital allowances, that's depreciation. This is represented in this Z. And then from that result, we then multiplied it by the income tax rate for that period. That was when we took that 80 and multiplied it by 30%. And then if you take all of this, you ended up with 24. If we do this over here infinite number of periods, and consider that we need to bring this value to its net present value, deducting it, bringing it, essentially this term brings it to its present value, all of those different figures. T is the time and S is the additional periods. You end up with the calculation of the taxes over the project's lifetime. when we talked about basically the revenue that the net revenue that the investor's revenue net of variable cost in that each period, I can't say it, and I wrote the paper. We are essentially modeling a very simple production function, a linear production function here. That's what's actually behind this. And essentially, the revenue generated depends on the capital stock in the previous period, multiplied by the profit rate that we're assuming, and then corrected for inflation accumulated over those periods. So this is not the sum, obviously, but this is just for each period. It depends on this. We're holding inflation constant for the now, and then the capital stock itself depends on the capital stock from the previous period deducted of economic depreciation, which is considered fixed, plus any change in investments that occur. So, trying to close this now. Basically, if we look, for example, for a project where you invest $1 and then model those equations very simply with a profit rate of 5%, true depreciation of 15%, that means the capital stock depreciates at a rate of 15% per year, and then an inflation of 5%, you end up with these curves, these sort of curves that slowly go down by the point that, for example, like an investment of 1 in a capital stock, it has been reduced to 0.2 of that capital stock by year 10, and you can also see basically the revenue is also slowly declining through this progress. What does that mean when we actually apply it then? So the OECD has a database this is available online. You guys can check if you're interested. And basically what they do is they calculate these forward-looking ATRs for lots of different countries. It's OECD, non-OECD countries because of the inclusive framework that I mentioned before. So they're also looking at other countries. And basically what they do is what we have here in the bars in orange. This is a statutory rate that we looked at the start of. Essentially, it's difficult to view, but it's the statutory rates from that first figure that I showed, that slowly declining rate from, well, I don't include all countries because it didn't fit. And basically the blue bars are the effective average tax rate, the forward-looking effective average tax rate, which is the indicator we're calculating. The point of this figure is to show that even under this, let's say, without modeling any provisions or any tax incentives, there's a bit of deviation between the blue and the orange bars, essentially because standard, let's say, tax systems kind of favor some types of, let's say, tax depreciation can be higher potentially in some cases than actual asset depreciation. We can talk a bit more about this later. But what it means is now we actually have a way to compare tax incentives. So we got to the point. So essentially, we use this essentially this framework that was work that was already being done at the OECD to then expand it to introduce tax incentives within that context, within that modeling framework. And this means, I won't go through the slide, but this means that now we can actually put them in that equation. So I've been talking about all these different types of incentives. What does it mean when we introduce, again, looking at the waterfall chart that we had before with no tax incentives, what does it mean when we then introduce tax incentives into that calculation? Remember our 130, our net revenue of 100, which was the same point that we had from the previous slide. Then what happens is you still have standard depreciation, even if you benefit from an incentive. The thing is that you might have other types of tax allowances, just like those tax allowances we had in that graph initially that I showed from the investment tax incentives database, and that actually might increase your tax allowances further because you have access to different incentives. That means that your taxable income, this one in green, is actually going to be lower than it was before, which means that the tax rate, even if it's not a reduced tax rate, or if it is a reduced tax rate, will bring you to taxes before credits or taxes due lower than it was before. And you can also have tax credits that apply before the actual tax due, which can bring your tax due even lower. And that means you end up with tax, essentially, means that the incentives worked. And the tax due is actually much lower than it was before. I think before it was 24%. And this is illustration, it's 14.5, for example. So how do we introduce that into the equation? Essentially, we start up with that tax equation that we had, the same one that we had before, and we're going to introduce terms to it. Basically, here what we do is we can introduce, for example, tax exemption. So we add a term essentially correcting that net revenue, sorry, the Q. It's the revenue net of variable costs. And we basically say, well, part of that is actually not going to count for the taxable income calculation. So we can reduce it by a factor here, either 100%, 1 minus 1, which brings us down to 0, if it's a full exemption, if it's a tax holiday, for example, or not. If we want to add different allowances, we can take this term, which actually modeled the tax allowances before. We can, that's why it has a little star, so we can add accelerated depreciation, initial allowances, which are different types of tax allowances. We can also add additional terms, which are called investment allowances, which increase the total value of the capital depreciation that you are allowed to have for a certain expenditure. There's another type of tax incentive. We can use this equation to change the rates that apply. And we can also add tax credits. And the nice part about this is because it's a summation over the average lifetime of a project, it means that essentially you can take different periods and you can have, as let's say, for example, this is the tax rate. You can have tax rates that vary over time. This one should also have a timestamp, but this can also change over time. This changes over time. Everything changes over time. So you can model incentives that are temporary. That's the key thing. So let's bring it all together because I only have 5 minutes. Essentially, this is what we then have in the paper that I was mentioned at the beginning of this whole discussion. What we did is, with this framework, which is explained in this working paper, we then said, okay, so we have this framework to model incentives. Let's look at a subset of countries and see if we actually apply it. What do we see, right? So what we did is we mapped incentives for the 7 countries: Angola, Botswana, Kenya, Mauritius, Senegal, Eswatini, and South Africa. And using the investment tax incentives database, which we had collected information before, detailed information before, we took a look at all the provisions that they had, looking at, remember, Pillar 1, how do they benefit, what are the incentive design? We mapped it out. And then who benefits from them? What are the conditions to benefits from these different incentives? Are they sector specific? Are they policies related to special economic zones, geographic regions? A lot of different things. We end up with a lot of information, complex, and then we need to see what angle we're going to use to actually make sense of it. So in this paper, what we did was actually, we said, let's focus on 2 different sectors. A lot of these countries actually had policies that were targeted at developing in certain industries. So for example, there was a lot of countries that had policies targeted specifically to support the food industry or the motor vehicle industry. It exists in South Africa, but it was quite Kenya, for example, had a lot of incentives targeted at the motor vehicle industry, for example. And what we did is, using that framework of EATRs, we calculated the ATR for different incentive policies that exist, matching it with information on the standard baseline tax system of each of these countries, including their standard depreciation provisions. And that allowed us then to arrive at these graphs, which have basically each column the EATR of different incentives that apply, either specifically target or also benefit the food industry. And even though they're applied to different different tax incentive instruments, you have credits, allowances, exemptions, different instruments, we can put them all together. And what this allows us then is to say, well, in the food industry, a food investor in the food industry, which of these countries would actually have a larger tax break if they were to benefit from this incentive? And we did the same. And you can see, for example, that the order is slightly different for these, if you look at the horizontal axis, it's a bit different because some incentives apply only to certain industries while others don't. So essentially, the conclusion is that tax incentives do change the tax competitiveness of different industries if you take them into consideration. What we also looked at was basically taking a look to see if these countries were then the incentives that were being given to these industries were incentives that were being given to industries that were established, or they were basically emerging industries. So the idea is, ideally you want to focus your tax incentives on nascent or like emerging industries to support their early development, but ideally it makes less sense to support a really well-established industry. What we saw, it was a bit mixed, and this is because it's a small sample and it's only 2 sectors. This would need to be done for more countries and basically more industries. But basically that you do have some countries, this is the top right quadrant, where countries where they're basically industries that are more well established, either measured in terms of their contribution to GDP or their share to exports, but they're more established, but they also have a higher degree of preferential tax treatment. So the idea is to question whether those incentives should be in place or not, because they seem to be supporting industries that are established. Another thing that we did in this paper was actually to take a look at the incentives within special economic zones, which I mentioned from the entire discussion are actually a key issue for this discussion on investment tax incentives. And then what we saw essentially was that most of them actually, I think, reduced rates. Most of the countries, in this case, they all had either reduced rates or tax exemptions, different durations, different designs and everything. But when we bring them together, we see that actually you can actually put them in, let's say, compare the competitiveness of these special economic zones across countries. And essentially, the little X tells us if that and the incentive within the special economic zone was actually the most generous incentive in the country or not. And what we see is actually in most cases, the most generous incentive happens within special economic zones. So if you want to prioritize, it might be worth taking a look at these special economic zones, because that's where the big tax breaks are actually being given. So, conclusion. Essentially, what we found was that tax incentives are complex, which I think you will agree with me by now, and that actually understanding them is also complicated, because you need to have an understanding of what sectors, what locations, what target groups benefit, how generous the incentive is. So you need to add nuance to this. And the fact that it's complicated means that there's reduced understanding of the policy's impact, and the reduced understanding of the policy impact is something that holds you back from making better policies in this case. And essentially, it's also an issue because when you try to then estimate the costs and the benefits, it makes it complicated, essentially. What I won't be able to present today, but what is mentioned in this paper about further work, is that we saw 3 areas that we could use this essentially for. Essentially, it was for doing case studies, either looking at one sector in multiple countries, a region, going to detail in one specific country, looking specifically at SEZs, or increasing the model complexity, because as you saw, there's a lot of simplifications that we do, or it's a basic framework. I did continue to work on, and colleagues as well, is we did continue to do work mostly on this case studies. Unfortunately, that hasn't been published, so I can't talk about that much. But what I would say is that there was generally a lot of interest from different governments in actually seeing how they rank. I mean, from the published data, the baseline ATRs, the modeled ones that I showed, the bars with the little graphs, the little blue dots, there was already a lot of interest and a lot of from countries in seeing how they rank compared to other countries within this graph. There's published data on the ETRs for R&D tax incentives within the OECD website. If you're interested, you can have a look at that. But it's the same for, again, in the mostly developing country context, that they're also interested in understanding, countries are really interested in understanding how do their SEZs compare to other countries. So are you actually tax competitive? Because if you are, and you're still not succeeding in your special economic zone is not successful in attracting investment, then the issue is elsewhere. So with that, I will start closing, but I just wanted to quickly talk about this very quickly. But essentially the 2-pillar solution, it ended up there was an agreement in terms of implementing this in 2023. There was a lot of discussion before and afterwards in terms of what are the specific rules, how this would apply, how the rules would apply. Essentially, a lot of discussion. It's very complicated. And by that point, it was already 138. I think now it's 143 countries, if I'm not mistaken, that had agreed to sign this. But it eventually took place, and if you're interested to see where your country is, the PwC actually has a Pillar 2 country tracker where they show basically the status of where your country is in terms of implementing Pillar 2, this global minimum tax. In parallel, there was this emergence of the UN Framework Convention on International Tax Cooperation, which was, in my view, driven by the Global South frustration with this process of the global minimum tax happening at the OECD, in part due to, let's say, limited reallocation. That means less tax revenue that they would benefit from implementing this minimum tax, a low 15% ETR, tax carve-outs that I don't have time to discuss, but basically it was a proposal to move the tax rule-making body, let's say, from the OECD to the UN to make it more inclusive and more inclusive, essentially, and more representative of developing countries' point of view. In terms of recent events, it was 2024, where the terms of reference, so what the mandate for this committee or this convention would be, that was established. So it's fairly recent. If you're interested, you can go to the Tax Justice Network. They have a whole page that keeps you updated on the UN Tax Convention, what's going on there. It's quite interesting, their page. I am not fully up to date. But as you can see, the last session was in November of 2025, so it happens multiple times a year, not only at the the UN General Assembly. And just to close here, without going into too much detail, essentially what happened, Trump, when he went into office in January last year, there was a lot of headlines talking about him dropping off the Paris Agreement. He also exited the global tax deal at the OECD. So what followed last year was actually a tense negotiation between countries in terms of how to deal with a non-cooperative US, and what does that mean for a global deal without the US, which I'm sure a parallel discussion was happening at the UNFCCC. But essentially what happened was you see January 2026, by last week, was that there was a new agreement sort of to save this deal, include some new provisions, we can discuss that later, but to still make a case for developing countries to adopt it and still have a deal that was agreed on. What that means, to be seen, but we can discuss a bit that after. And in view of time, I'll stop here and hand over to the discussants. Thank you.